Very nice, very nice. So we're recording this as well for for our people who could not join us today. They can listen to this conversation hopefully later during their free time. Just about myself, just wanted to introduce you quickly. I'm 41-year-old. I'm a dad of three children, and I consider myself a lifelong learner. And professionally, I worked for a premier oilfield service company for about 16 years. I have a master's in chemical engineering. I've written a few papers in the area as well. And right now, I'm an entrepreneur. I have my own company, and just trying to excuse me, I have this Azan software going. I've started my own company 1.5 years back when I left Schlumberger, and just trying to make it happen. At the same time, I invested in the market for a long time. I bought my first stock when I was 18-year-old in 1998. And the market has I've been obsessed with the financial market. I'm a financial market enthusiast. I've been an investor, I've been a trader. And I want to distinctly mention the difference between the trading and investing. And I think that will be one of the main part of our discussion today. And how can we separate those two mindsets, and how can we look for long term? So yeah, that's about me, Brother Fahd.
All right, thank you very much, Afzal. So basically, me and Afzal have discussed a couple things before this, scheduling of this meeting, and why we want to meet and what we want to discuss. My general idea for having this discussion and a meeting was to, give a little bit insight on not just like what is a stock, and what is the security and all that, but just a little bit more advanced than that. And our topic of discussion would be to get our hands around what is investing, what does it take, what's the mindset. As Brother Afzal said, there's a difference between being a trader and being an investor. And I feel what I've learned, this is two different parts of a personality, right? It has a different mindset. And this meeting is basically prepared from an investing point of view. We're talking about goals that are mid long term to heavy long term, like waiting upon years and stuff like that. So that's the start of the conversation. And we will have more such meetings. So this is not going to be just one off. And from here, the conversation is going to start. The conversation is going to build. And if you feel like, oh, I'm a newbie to this, don't restrict yourself. Any question is a good question, first of all. But also know that this is not just going to be a very basic introduction and all that stuff. So Brother Afzal has prepared a lot of talking points. He's going to give us a lot of information. So having said all of that, I think we need to get moving forward, Brother Afzal. We have more than 25 more people. So if you have presentation and if you want to get started with screen share, I think let's just go ahead and do that.
Sure. Let me start the screen share, and let me know, brother, when you see my screen.
I can see your screen, definitely. And for all the brothers, just do the reaction. Like if you want to just raise the hand if you can see it. If you're not, then
a couple of raised hands will be good.
Yeah.
Okay. Very nice. Very nice.
Awesome.
So, guys, here's the slide that is about my investing philosophy. And as I said, I've been buying and selling stocks since 1998, and have seen 3 recessions now. I was very young when the Nasdaq dropped precipitously in 2000. And that has left a lot of scar on me as well. And I've been reading since then, and that has also impacted me deeply about one part of the market and how that part of the market impacted my investing philosophy or my general view of the market, and that has kept me away from big gains in the 2010 decades, in the decade of 2010. And that is something that I want to share with you as well. And there are a lot of mistakes that I made, and I still commit mistakes. I still being a that's the fun being a lifelong learner, that you are not going to stop making mistakes. You will be making mistakes. Mistakes are bound to happen, and in order to learn and improve, you need to make those mistakes. But you need to realize that you're making mistakes. If you don't realize and analyze those mistakes, then those mistakes are not going to be useful. And hopefully, I'm going to share some of the things that I learned during my life so far, and hopefully, that will be helpful. So number one is in terms of my current investing philosophy, that I want to invest in businesses and not the market. I know it goes the other way around because we are talking about stock market here, right? We are talking about making money through stock market, but I don't want to invest in stock market. I want to invest in good businesses and hold them for a long time. Hopefully, I don't want to sell those businesses ever, but that doesn't work. You have to sometimes sell, and how often do you sell will actually will differentiate you, the investor, from the trader. If I have some gains, 10%, 20%, 30% in 1 month or in 1 week or sometimes even a day, and then I sell, well, I'm a trader. I'm not an investor. And I've made those mistakes. I have traded, very good stocks of last 10 years, the Facebooks and the Teslas and the Apples and the Amazons and the Googles and the Microsofts. I've traded them for a very short-term gain of 20, 30% and gave a pat on my back. Oh, I made 20% in Apple, 30% in Apple. Now, you know what? I lost out on 20x on Apple, or 10x on Facebook, or 10x on Tesla, well, I got some Tesla, by the way, but yeah. So that is the difference I would like you guys to make, that when you're investing, you do not need to sell too often, right? Let your winners run. And that's a very difficult thing to do, because you do not trust the market. Why? I've done a lot of thinking. Why do people don't trust the market? Because they have seen businesses and the stock prices coming down precipitously. And I mean, there's a classical paper from Arizona State University of Professor Hedrick, and he came up with a paper in 2016, I believe. And I have that paper, by the way, open with me, and I can share it with you guys later on. He has analyzed, 26,000 companies, right, from 1926 all the way to 2015. And what he has found is that more than 52% of the companies did not even beat 30-day treasury. So 30-day treasury is the yield that you will get 3-4% for that year, for that long time, but it's pretty much close to zero, right? And what he found out is that only 4%, hear me again, of the stocks that has made 100% of the gains, right? Which means that only 1,000 companies out of 26,000 companies has made 100% gain in the stock market in those 89 or 90 years that he has studied. Now, detractors or they criticize, people who criticize the study say that, he has taken all the penny stocks, and all the stocks that we don't even know of, and things like that. fine. Even if you take out those penny stocks, even if you take out the bottom, the long tail, so to speak, right? Yeah, you will take out 20-30% from that from the total. You might come up with 6%, maybe. That only 5 to 6% of the stocks have made 100% of the gains. And then he looked at it that only 96 companies out of those 26,000 has made 50% of the gains in the stock market. Which means if you are trading the stock, that is the winner. You are losing out. That is not investing. That has costed me more than my losers, believe me. So don't sell the stock if it's working. Of course, you need to be very, very careful of selecting your stocks, right? The selection, one of the tweets that I did, that your stock selection process should be akin to buying a house, for example. You don't buy a house just, you go to the market and buy a house. No, you do research. You look at which neighborhood I want to live in, what is my commute time, what the school zones are, how good are the schools, what is the price, how good is the kitchen, etc. Right? That's how it should be with your stocks for investment. You do enough, spend enough amount of time and judge the business, right? And you want to see that business is going to grow, right? And then you buy it. Now, the current, the Robinhood, the Charles Schwab, the current app platform, it's very easy to trade a stock, right? It's just swipe, couple of swipe and you buy a stock. That's a great thing, by the way. This thing has given us, this new set of discounted brokerage firms have given us a fantastic opportunity to buy, great companies of our lifetimes, right? With a swipe, right? But they go against you. You can sell that easy as well, right? Don't be part of that. If you have bought great businesses, keep them forever, right? Now, forever is just a term that I want to use, but it's never forever, right? The companies have the lifetime, right? The best companies, the 3Ms, the IBMs, the Ciscos, the Gs, the IBMs and Gs, by the way, have come down tremendously from the top, right? So what you need to do is not just buy the stocks and hold them, right? You need to buy, hold, and verify whether your original thesis is working. And what are those original theses that you want to buy stocks in? Well, we'll talk about some of them. So don't sell until the thesis is broken. Now, so when I talked about Professor Hendrick's study, about 26,000 stocks, well, S&P 500 is just 500 stocks, right? Why S&P 500 has given 10 to 11% of the gain in the course of 80, 90, or 100 years, or last 60 years, it has been 8.5% if you reinvest the dividend. Why is that? Why those 500 companies have done so well? You know why? Because it's passive investing. What do they do? Which companies come in the index? They have certain set of criteria. The committee meets every year, every quarter for that matter, and get very handpicked, very small number of companies to come in. And when you analyze those companies which they are getting in the index, they'll perform so well until then, right? The performance is one of the criteria, right? So if the brother asked me the other day, hey, this company is up 300%, how can I buy it? Well, that's why you need to buy it, because it has been up. Okay, now you need to look for that there's not part of the bubble, etc. Of course, right? And it's not part of the hype only. You need to differentiate that, and hopefully the strong business fundamental will help you differentiate those hype companies from the real companies that are gaining momentum, that are gaining. But the stock index buys good companies which have had good past performance until then, right? And then what do? They cut the bottom part, the losers, right? The companies that are not performing well with respect to business. They have a lot of criteria that they don't tell us about. They meet and they decide. What it means is that we can borrow that philosophy. Right? If I want to beat the market, which means I want to beat S&P 500, then I need to borrow the philosophy that works very well for that index. For an index like NASDAQ 100, on an average, they take out about 12 companies per year, which means that the churn ratio is about 12%. For S&P 500, the churn ratio is about 4.5%, give or take, if you take the long enough time period. Well, if I want to beat that with individual stocks, I need to be in that ballpark. I can sell about 10 to 20% of the companies in a year, right? Which means you've got to give at least 3, 4, 5 quarters for your thesis to play out. You want to invest in Zoom, for example, or you're invested in Zoom, you've just seen it, right? Zoom has gone up all the way to $600 or $585 for that matter. And then now back to what, $350 or $340 as of today. Got a 40% decline. But if you were the momentum trader, you would be out. But if you want to invest in Zoom and you really believe in that business, you should be in now and check out what happens at the other side of the economy reopening, for that matter, right? How would Zoom perform? If you were a believer in that business, you would be even buying now, right? So that's the difference between a trader and an investor, right? Now I want to introduce one more term in my philosophy, that I'm looking for high slugging ratio with acceptable batting average. Now that's a lot of jargon, by the way, but I'll make it very clear. What I'm looking for is, what is batting average? You buy, let's say, 100 stocks, right? By the way, I have 100 plus stocks, and one should buy a lot of stocks, not just one. And then I have some sort of guideline for that as well for myself. Let's say if you have 100 stocks, in a year, 50 stocks go down in a year, okay? And 50 stocks go up. That means my batting average is 50%, which means 50% have lost money, 50% have made money. Now, if they've lost equal amount of money, right, that they've gained, then I have no IRR. I mean, I have no rate of return. My rate of return is 0, right? That's where the slugging ratio comes in, right? That whenever I'm right in those 50 stocks out of 100, they are making more money than the amount that I'm going to lose on those 50 stocks. That's how I can make money. That's how my investment can grow. That's how I can get a good CAGR, compounded annual growth rate, right? That now every year you follow it every year. So I'm trying to look for high slugging ratio, which means if I've got a winner with me, I want to let it run. I want to let it compound, and I want to have a higher ratio. I want to make a lot of money with my winners, and then start cutting your losers. But don't cut your losers so often or so frequently or in such a short time period, right? You've got to give 3, 4 quarters or 1 year. And then let's say, this is my philosophy, I want to have about 10% churn rate. But whatever I'm telling you now is very, very difficult to do. It's been long battle, for me to learn that. Am I there at 10%? No. Do I sell more than that? Yes, I do, right? But I'm trying to focus on that how can I give enough time, right, for my investment thesis to play out if I'm investing in those businesses. Well, how do I select? I try to select the industry leader or a disruptor, right? In a given trend, widening competitive moat. What is the meaning of moat? I'm introducing another term. So moat is, you have a castle, and you basically have that, a kind of a moat around your castle that will not let your enemies attack that castle, right? And The competitive mode, comes from Warren Buffett, and people have, used it quite often, and I want to use it too. That I want to invest in a business where the business is not just safe; it is becoming safer day by day, which means it's having a moat. For example, Google is a fantastic competitive moat. Even if you want to spend $100 billion today, $100 billion, and say, I want to have Google search engine, you will not have it. Even with $100 billion, you cannot make Google search engine, because what makes Google search engine the Google search engine is the data that we all feed in every day. It's like a devil that eats every day and gets bigger. The bigger it gets, the more it eats, and the more it eats, the bigger it gets. You're getting my point, hopefully. So those are the kind of businesses that you need to be focusing on, where the moat is widening as they do more business, as they get more data. And recurring revenue, it's one of the other things that I look for in my businesses. That do I have recurring revenue in my business? What do I mean by that? That people come every year and buy again and again and again. Software as a service businesses, by the way, have got very nice recurring revenue stream, right? I have an excellent example of Atlassian, company called Atlassian, the ticker symbol TEAM, team. When they sold $1 worth of stuff to the customer, and they look at after 5 years with the same cohort, they sold $8 worth of stuff after 5 years. They are not just recurring, coming back to the company to buy more, the customers, but they are buying more and more every time. They've got, very less churn. Those are the kind of recurring revenue. I mean, Microsoft Office is an excellent example, right? You have Word, you have Excel, you have PowerPoint, or you have any of those Microsoft products, not only just Office, but even the operating system. You have to keep paying them. The companies that you work for will keep paying them, right? And that's the excellent example of recurring revenue. Network effect, I want to invest in the companies that has got excellent network effect. And what do I mean by network effect? That, okay, a company buys and then a customer buys your product, and that customer tells another customer, or that customer can bring another customer just by an example, right? So example of network effect would be Shopify, for that matter. Shopify has got excellent network effect. Another example for network effect would be Fiverr, business Fiverr. That's got an excellent network effect. They are going viral now. We need to be worried about the fad as well, that you don't invest in fad, right? Then I look at long-term market trends, right? What is going to change our lives in 10 years or 15 years from now, or 5 years from now, or as we speak, what is changing our lives, right? What are the businesses that are, what are the market trends that are coming, such big secular trends that are changing our lives, right? And then finally, I want to introduce another term, this past inflection point of technology or product adoption life cycle, which is at the phase 2 of the S curve, and that's where I brought the S curve. This is the example of S curve, for any given company, this is applicable not just for companies, but also for products as well. So I'm going to use the company and product interchangeably, but you get the message. That let's talk about if there's any company which is in the introduction phase, which is a very young company, a startup, and then when they become, kind of public company, we don't know when the startup people, the VCs and the angel investors want to go public. Once they want to go public, that's when it's available to us. By the way, I don't invest in IPOs right away, and I think we'll talk about that later. Why shouldn't we invest in IPOs right away? There's a period that you should wait before you actually jump in the IPO, in the best IPO that you want to invest. But notwithstanding those points, you look at the business which is at the growth stage. I want to buy companies right here when the introduction is over, when people are using those products very well, and that has gone to the trajectory of hyper growth, for that matter, and that's where the maximum growth for the business can come in. and you will see that more often than not, your share price gains or your CAGR for that company will probably coincide with that. Now there can be a lag between the two. Sometimes people pay up, means the stock price go up before even you got to those growth or maturity stage. Before you got to the inflection of the growth stage. Or sometimes it will come later. In the case of Tesla, and we're going to talk about Tesla as a case study here, because that's one of the favorites of the street this year, and favorite of all of us, the home gamers, this year as well. So we'll talk about that. And there can be a lot of delay between the business growth. Business can grow really, really fast at that time, and the stock price growth, and there can be a delay. It can be up front. It can be coinciding with the business growth, or it can come later, right? But what I want to invest in the companies that this is another example of S curve. When you go through adoption of the technology, it can happen really, really, really quick. For example, smartphone. Smartphone is right here. I mean, in last 8 or 10 years, we saw a big, huge jump in smartphone, right? And the smartphone has been around, let's say, since, when was the first time I bought my touchscreen phone? Was 2005, actually, not much before Apple. But when Apple came up with the product, when the market was ready, they were not the first one, by the way. As we know, they're not the first one, but they were the first one when the market was ready, or actually they made the market ready. And then you see in this 10 years how quick that adoption was. You see in the earlier days, even the adoption cycle, the S curve was not as dramatic, for that matter, as the later days or nowadays, right? You look at cable TV, you look at cars, you look at PC, you look at video game, you will find very similar. That's when the maximum growth happens. And if you want to make a lot of money in your investment, right, which we all want to make, inshallah, and beat the market, you want to be in those companies at that time when a hyper growth is happening, and you're going through this inflection point in your S curve. Now, as I said, the company can spend a lot of time in this phase and never actually come to this phase in terms of stock price, by the way. It can be in terms of the business, but it may never come in terms of stock price. And those can be fads, by the way, that they can fade away. And if you look at what are people, this is one of the other mistakes that I did. I've been, alhamdulillah, early adopters of many technologies. And by the time the technology became ready, I was out of it, or it did not interest me more, or it did not interest me as an engineer or as an early adopter. Touchscreen phone, if I used it in 2004, it did not interest me in 2010 when Apple came up with iPhone 2 for that matter, iPhone 3 for that matter. But that's when the market was ready. That's when it really took off in the mass market. And you know what? I missed out on some of the Apple gains. A lot of Apple gains, actually. Not for that reason. There were other reasons as well. It was very expensive. The valuation is another thing that knowing too much about valuation actually goes against you sometimes. Sometimes you got to pay up, and I'm not talking about the stock price here. I'm talking about the valuation in terms of some other matrices that the industry use. So yeah, that's very much about S curve investing from my side. So just want to give a little bit of pause. Fahad, do you have some comment or questions here that we can take and before moving forward? Well, Fahad? Well, Fahad, you're on mute.
Brother Afzal, I think he stepped out.
I think so. I think so. We'll continue. So I'm gonna talk about Tesla here. Tesla. Why did it go up so much this year, and what has been the reason for this? Tremendous. These are power law returns, by the way. This is exponential. Exponential rise, and that's what I'm trying to look for in some of my business as well. That when I want to invest in the business which are young, so to speak, in terms of the growth, in terms of the market acceptance, in terms of market readiness as well, then you can get exponential growth. And most great businesses, even if you take IBM, Cisco, GE, they have got this exponential rise timeline, and that's what you want to catch. You want to catch those and don't sell during that exponential rise. If you're buying and selling Tesla this year, which I was doing, by the way, as well, and I've been a biggest culprit of that. Well, you will lose out on a lot of gains, a lot of life-changing gains, right? So what I do is try to study Tesla very, very closely. What has happened with Tesla? Why did it go 10 times this year? When I look at the history, by the way, I did not buy Tesla in 2012. I actually bought and sold in 2012 and 2014. And I'm not alone. There are so many people like me. But when I look at compare the business, what was business doing for Tesla? If you look at 2014 to 2019, almost the stock price went nowhere. Okay, in those 5 years, Tesla heavily underperformed the market. I believe market went up at least 65+% in that period, if I'm not wrong. Or even more. The market makes S&P 500 and Nasdaq even went probably about more than 100% in those 5 years, 5.5 years. So Tesla didn't move. What was happening at Tesla? The business was growing. Look at this business. This is the trailing 12-month revenue. This is the revenue of the business. From 2014, you were about close to $1 billion. By the way, this is $1 billion. And 2019, you were more than $20 billion. Right? From $1 to $20 billion, but the stock price was not increasing, right? The street or the investors were wary of Tesla. They did not think that Tesla could make it, right? And yet, people who held on to those stocks since before 2014 has made 100x in their lifetime, in the 10 years, right? People who got in here, okay, fine, we made double, we made triple, who cares? People who made 100x has kept up with Tesla during the tough time because they believed in it, right? So if you have a business that you believe in that will do great, and if it does not give you gain for a year or two, don't sell it. If you believe that that business is going to take off, give it enough time. Now, so I'm preaching buy and hold, right? But buy and hold doesn't work everywhere, right? If you have just 5 stocks and you do buy and hold, and what if you're wrong in all those 5 stocks? Well, you know what? Your gain will be 0 in just 5 years or 10 years that you want to work. That's why you should not be holding just 4 or 5 stocks. If you want to apply the buy and hold strategy, it cannot be on 4 or 5 stocks. I'm sorry. You need to go for at least 30 of 45, 60 good stocks. You have to spread out your risk. You have to diversify as well, right? Or what is the diversification? That you do not want to have all the eggs in one basket. If you have Tesla and NEO, and let's say if you want to put Tesla and NEO, you can put 2% in Tesla and 2% in NEO, or 3%. I don't put anything more than 3% of my money for any stock that I want to buy, because I have done it. I have put 100% and lost 80% in that, right? I put 100% of my money in a single stock and lost 80%. I believed in so much. So don't believe in any company so much that you put, an excess amount of your hard-earned money into one stock. Stocks are by default very risky. It is not just about what you think, it's also about what people think that that is a good stock or not, that is a good company or not, right? So in the case of Tesla, by the way, here it is. Tesla is no future in 2012. People said Model S was fluke, and yet the revenue was rising exponentially from $413 million in 2012 all the way to $21 billion in 2018. It continues right now. I think it's $25, $26 billion plus. And they were building factories all around the world. The third factory is being built in Austin right now. The fourth one, rather. The first one is in California. The second was in China. Third in Germany, and the fourth one is being built in Austin now, right? So when Elon Musk was focusing on making the infrastructure ready, it actually gave you the chance to invest in Tesla, which will be typically reserved for VCs and angels, right? And he was in the public market out there and giving us a chance to invest in. And if we were like the street looking at a day-to-day noise, we would be buying and selling. There's a lot of noise, and you need to cut through those noise if you want to buy and hold great businesses, right? And no matter how great the business is, it does not deserve more than 3% of your money, believe me, right? Let it organically grow. Let it earn the space in your portfolio, right? If you bought Tesla, 3% of your hard-earned money, and it goes 10x, well, it might become more than 20%. Hopefully, your other investment will also go up. Let it earn that place in your portfolio. You don't buy it. You buy them enough, and then you say that, okay, now work for me. I put the money in you. Now you work for me, right? Don't chase those. I've chased those and put 100% of my money in one stock and lost out 80%. The other day I was mentioning to my friend, 80% loss. If I have an 80% loss, how much money should I make to compensate for 80% loss? If you tell me it's 80%, well, I'm sorry, you would be wrong. Because if you have lost 80% of the money in one stock, you need to make 500% to be break even. You need to make 400% to be break even, actually. So $100 goes to $20. Now $20 has to come up by 400%, means 5x, to make it to $100 again. So it's not the same math, guys. Percentage is not the same math in terms of percentage. And that's why you should be spreading out your risk and differentiate yourself, from trader to the investor. And then you need to be holding those stocks for a long time, like Tesla investors did. Those who bought Tesla at $30 in 2012, post-split, it was $6. Right now it's $700. They made more than 100x in 10 years, or less than 10 years for that matter. You can tell me, well, Afzal, it's all well and good, but how can I find Tesla for next 2020? Do I have an answer? No. Does anybody know what will be next Tesla-like growth for next 10 years? Nobody knows. That's why I want to buy some great businesses, 60, 70, 80, 100 businesses, and see if there is any Tesla in it, right? That's where my slugging ratio comes in. And if the business keeps performing, which means the business keeps growing, then I want to be in that stock. I don't want to sell it when I see a headline, oh, XYZ company did not meet the consensus estimate by a penny, and I sell a stock. No, I'm not going to sell my stock because it did not meet the consensus estimate by a penny, or it has got some gap losses for that matter. If it is growing well, if my total addressable market is expanding, I'm going to keep that stock, and I'm going to let people play their game that even may give me some time or some chance to even buy more if I'm underweight. If I'm much less than 3%, I will get a chance to buy more if they knock my good company down, right? In fact, I sometimes want them to knock it down so that I can buy more, right? For example, I was hoping for a long time that Shopify should go down so that I can buy more. I was hoping for a long time that that Atlassian should go down so that I can buy more. And when you get those, I'm getting a message from Brother Ford. Anyway, so yeah, that's how I want to buy and hold. That's how I want to choose my business. One of the other things when I want to choose a business, I don't. So let's say I've come across a business. Let's say somebody brought me a business. I don't know what example I want to take. Fiverr. Let's say. I don't want to read anything about Fiverr, any news about Fiverr, not at all. I don't want to look at even the stock chart of Fiverr, because that my process, according to my process, that will disturb me, because I may think, oh, Fiverr has 400% gain. How can I buy it now, right? And that will disturb me. What I want to go do is, or what I do is, I go to the investor relation website of Fiverr and let the company pitch to me, which means I have to go there, of course. It's not going to come and pitch me because I'm not a billionaire, right? If you're a billionaire and then a VC, for that matter, people will come and pitch to you. But no, here I'm not a billionaire. So I have to go to the investor relation and read about the company, what company is saying about themselves. We buy a stock without even knowing what company does. And then if some people, then they become a little bit, engaged. They go to, they start reading news. I'm sorry, news should be the last. You should know fundamentally what industry that company is, what business it's doing. And you may take a month to do that. You may take a few weeks to do that. Who cares? And in that time, the stock may go up by 100%, fine. If you want to invest because it has gone up by 100%, you don't want to invest because it has gone up by 100%, then you were a trader, right? You were after that 100% gain. No, we are not after that 100% gain. We are after that, 10,000% gain or 1,000% gain, right? That I want to buy and hold it forever. Then I may take my time to look at my stock, to look at my company. So once you look at the company, you look at the space. Is it and guys, you need to create a people surrounding you to be a right network. Right network has impacted my investing decisions a lot. When I was surrounded by the people who were traders, who were looking at the price today and price tomorrow. By the way, I do look at it. It's actually very addictive to look at the price on your cell phone, right? And everybody does that. But where you have to stop yourself is not to click that button, sell button, by the way. Buy button, yes, you can buy and check it out. So you've got to surround yourself with the network of people, those who speak the same language, not the trading language, not the price up and down. Price up and down, I can see it myself. I don't want anybody to tell me that Tesla went up by 10x. No, I want people to tell me when did they buy Tesla and what was their investing thought process. If there's a guy who has bought Tesla at $6, by the way, I bought and sold Tesla at $6, right? Believe me, I lost out on 100x, of course. That is what has made me what I'm trying to do today. That I don't want to lose out on those 100x. I don't want to lose out on, I bought Apple and $6.90 pre-split basis because it was split 2 times, right? It was split 1:7 8 years back and 1:4 this year. Pre-split, I bought pre-2 split. I bought Apple in $192 and sold it at $220. Oh, great! 10% gain or 20% gain. I give myself a pat on my back. But hey, you know what? That was actually $6.90 stock. If I was holding that stock right now today, it would be $133 as of today, or $134, right? So yes, I made those mistakes. Surround yourself with a good network of people who speak the same language, who want to, buy and hold those great businesses. Buy, hold, and verify, by the way. It's not just buy and hold, because I bought and hold a lot of oil companies, and I'm still holding some of them, and they were not great investment because when they were those oil companies, they were at the decline stage. They are actually at decline stage. There's a big shift going on around the world with EV, and people don't see future with oil. And it doesn't mean that those companies are going to go out of business. No, it doesn't mean that you don't work in those industry. You might work in ExxonMobil for next 15 years, 20 years, and make a good money for yourself. But I'm sorry, the ExxonMobil is not a great stock to buy right now. It cannot be because it's on a decline phase. The ExxonMobil was a great stock to buy in 1970s and 80s. If you had held that through, you might be, I don't know, 20x, 50x now. But not anymore. And that's what I want to differentiate myself. That I want to be in the industries that are growing, that has got secular trend behind it, and that is not on the decline stage. So yeah, I think that's about Tesla. I think I've shared my growth investing themes with you guys. My stocks, these are some stocks.
बिलाल बोला कि ऊपर का बाथरूम यूज नहीं करना.
I think I'm hearing something in Urdu. So yeah, if you can mute yourself, that would be good. So these are the themes that I'm invested in right now, in some secular growth names, in some software names. Software is an amazing business, by the way. It's eating the world, and I agree. Actually, software is eating the world. In the ad tech business, all the advertisement, digital advertisement, the big data. Data is new oil, guys. When you hear data is new oil, what does it mean? It doesn't mean that data is replacing oil physically. No, it means that the oil companies that has given you great gains, the 50x and the 100x in last 30 years, the next 20, 30 years, those gains or similar gains are going to come from big data, right? E-commerce, I mean, we all know how e-commerce trend has been, right? And by the way, why don't I have Amazon? I have Amazon. I have those top 5, by the way: Amazon, Apple, Google, Microsoft, Facebook. And I never want to touch them. No, not until I see significant signs that those businesses have now entered into decline phase. Apple can be very close to it, but no, 5G can save them actually. Amazon is no way close to decline, no way. Can you hear me, guys?
Yes, now we can.
Yeah.
Now we can.
You were muted for a little bit. Yeah, we lost you after you said Amazon is nowhere near decline phase.
Correct. Okay. So yeah, Amazon, I'd like to believe, is nowhere close to decline phase. Microsoft is nowhere close to decline phase. According to me, Apple was, but I think this new set of 5G, I think that's a super cycle that's starting right now, and that's going to take them to next 3-5 years, and then we'll see again in 3 to 5 years. They're nowhere close to decline state. And then you hear this, antitrust going after these big businesses, and then you sell your business investment. No, please don't do that. I've done it. I've looked at the antitrust. Oh, antitrust is going to do this and that. The government cannot do anything to this business, guys. It's just a noise. These businesses have become so big, okay, so much, it has permeated our lives, our daily lives so much. That's why actually government is going behind them, right? Because they have become more powerful than even government, right? Around the world, and especially United States. And hence they want to go after that. They want to do their job as politicians, that they're making them accountable. It's all drama, guys. It has got no significant impact on their businesses. So please differentiate those dramas from real business impact. They're going to continue to grow. They will keep finding the ways to grow, right? Google, for that matter, is same thing. It might be slower growth than other in terms of stock price, but I don't think they're done. They're nowhere close to decline, and hence you should be holding them. You should be holding them and buying them more if you like, right? So these are the businesses, those top 5, I always have them, and this 60, 70 businesses is what I believe is at the inflection point or just past the inflection point on the S curve, right? And they need to be well diversified because you don't need to be in the same businesses or same set of businesses. As I said before, they need to be either industry leader or the disruptor. Zoom, for example, was not a leader; it was a disruptor. But then it is becoming now a leader. ADSK. This is another example. How many of us are engineers here? I bet a lot of people are engineers, and a lot of people know what AutoCAD is, right? Is there any competition to AutoCAD? No, nothing. Should you buy that business? For sure. You should be buying and holding the ADSK, the maker of AutoCAD. Adobe, you had those businesses, the Corel Draw and things like that. Well, there's a lot of content creation done right now, and Adobe has got 300, 400 lines of businesses actually, and products. Sorry, not business, product. 300, 400 products, if I'm not wrong. I think it's 250 plus products, if I'm not wrong. And they're great products. Buy and hold it. The e-commerce. I mean, Shopify is not same as Amazon. It is not. Amazon has actually thrown a towel for Shopify. They've given up because Amazon caters to the consumers. Shopify caters to the merchant. There is a big difference between them. Etsy, handmade goods, they're making a big name for themselves. And then for e-commerce, I also gone to geographic expansion. Amazon is not very strong in Southeast Asia. It's Etsy Limited, which is strong. Mercado Libre is strong in Latin America. It's not Amazon. Amazon cannot do everything everywhere. So when I'm picking those businesses, so make sure also be aware that there can be multiple winners in the same market, in the same area. I mean, in the same industry. Okay, FTCH for that matter, Farfetch. It's making taking big strides in luxury items. And this luxury items, the Chanel's and the Gucci's, they're never going to die, and they don't want to sell Chanel's and Gucci's themselves. The businesses on Amazon, it is sold through Farfetch. So go and look at that, Farfetch. So yeah, these are the kind of businesses that I want to be in. But I believe we're at the at the inflection point of the S curve. How much time do we have, Brother Fad?
Brother, can you hear me?
Yeah, I can hear you.
Okay, yeah, we're not on a timer, so
Okay.
I scheduled the meeting for 2 hours, so
Okay.
that's the time.
Okay. I want to ask people. I mean, I think we should probably wrap it up in next 10-15 minutes. I know we probably said 1 hour to other people, but if it is interesting enough, I can continue going. What do you guys think?
Should be fine with me.
I think if we go for another 10-15 minutes, it's a good idea, and then break for Asu, inshallah.
Okay, fantastic. So here's the kind of diversification I have for the companies that I hold, and you can see is technology growth, technology conglomerate. Technology conglomerate is what I consider for the Apple, Google, the Microsoft, their technology conglomerate, and I want to invest in the companies that is helping change or shape the world, right? Helping shape the world means they're market leader, or change the world means they're disruptor, and you will find those. I don't go with the vanilla classification of tech and non-tech. That's too plain vanilla for me. It's if you know the business, and if you want to know the business, I think you can find good businesses everywhere. The other day, I did this exercise with my friend where him and I went ahead and we kind of counted how many companies that we use in our daily lives, in our personal life, and in our a professional life. When you work for some other company, if you're or if you're an entrepreneur, whatever that is, we came up with nice 40-50 set of businesses. They were actually part of our portfolio, changing our lives, and you just need to look for those businesses that are at growth. For example, you wake up, you use your soap, you use your shampoo, Procter and Gamble. I think that's probably a mature business. So I don't want to be in Procter and Gamble, But if I'm taking a breakfast, Starbucks, yeah, I want to be in Starbucks because the growth is still there. And so there's a great growth about Starbucks. So I want to be in that. You look at Microsoft. We are actually joining through Zoom for that matter for now. Is Zoom a great business? A good buy? Absolutely. Will you hear a lot of bad things about it? That oh no, it's gonna fade away. The pandemic is over. Everybody's gonna go to their normal lives. Yes, everybody's gonna go to their normal life, but is it gonna fade? Where is Zoom making money? What are the revenue streams? You don't. They're not making money through school. Do you know that Zoom is free for all the schools? So they are not making money from schools. The revenue does not come from schools. So even if schools have to decide tomorrow, which they will, by the way, that they will stop using the virtual learning because now we have the vaccine and whatnot, we're going to go back to our normal lives. Well, you know what Zoom was doing by doing free? It's making that future users in those kids. It's a very smart strategy. The free premium model. Free premium. Free to premium. And look at Zoom where this revenue comes from, and see if you want to buy and hold Zoom. So yeah, don't go on just what you hear. From your daily news cycles, because the daily news cycle, what comes in news, what comes in news is either it is completely erratic, like, oh, somebody made a couple of $1 million by selling their house and buying Tesla stocks. Yeah, that will come in the news. Do you want to be like that? Not at all. You want to be that boring guy who was holding Tesla since 2012. You want to be that boring guy, believe me. So you're not going to get those people from the news. You're going to get those people by having good set of network that will help you. So coming to selecting those businesses, you look at the business and separate them and look at the price at the end, guys. I've got a lot of friends, including myself, who has not bought a stock because it's gone up by 2% or 3% from my, so to speak, buy point. You may give up 2 to 5% today, but you want to gain that 100% or 200% or 1,000% later, right? So do not be obsessed so much by the price. And I understand why that price or entry becomes very important for many people. It was important for me. It is still important for me. So how do I try to tackle that is that I never buy a stock together, which means if I want to create a position in Shopify, let's say, and let's say I want to spend, let's say, $1,000 in Shopify, take any number for that matter. Let's say $1,000. I'm going to buy I will buy $300 worth of Shopify first, or $350, right? 1/3, $30. And then check it out. Check how it performs. It might give me another opportunity to get in, to buy again. Look for those opportunities. If you want to, not have such feeling that you are so much hung up on the price, then you should not be buying it together. Most of your US brokerage, or even for that matter, some Canadian, gives you that free no commission, right? So you're not worried about the commission. Why should you buy the stock altogether, right? Break it up in your 3 or 4 buys. Make a position slowly. Sometimes the stock goes up really, really fast, like Tesla. It doesn't give you the chance to get in. then you crank it up, right? Then you will learn that. You will learn how to make a position slowly or sometimes fast, right? But all your gains and losses. So let's say I want to create an entry in a new stock this year. Let's say Okta. I will buy Okta. And I bought Okta in $200. I bought Okta in $260. I bought Okta in $240. It doesn't matter how much did I buy it this year. This entry will impact your gain only for the first year. Because come 1st January, it doesn't matter how much you bought Okta for or how much I bought Okta for. We start from the same price on 1st January if we are tracking yearly gain for a given stock. And we all want to have yearly gains, right? We all want to have this CAGR. So I've actually this Vivas, this Viv company, let's say you bought a stock sometime in 2015. On 1st January 2016, your price and my price is same, right? Now we're going to track how much does it go up by in that year and the following year and then the following year. So for us, it will be 2021, 2022, 2023. So who cares if I bought Okta in $260 and you bought Okta in $200? Yeah, of course, in 2020, you had different gains than me. But in 2021, you and I will have same gain, right? And if you're buying and holding the stock for 3 to 5 years or forever, then that is what you need to be looking at. So please do not get hung up on the price in that year, because come January the 1st, everybody will start on the same page, just like you, okay? And then you look at the long-term effect. So many of the stocks that I'm hold, I know a brother commented me that a lot of my companies lose money. And I actually applaud him for actually making that observation, because that's such a good observation, that a lot of the companies that I hold are losing money at a GAAP basis, by the way. There are 3 types of profitability. A GAAP profitability, it's a generally accepted accounting principle. I don't look at GAAP profitability for my growth companies at an inflection point. There are many companies which are not optimized for profit. Amazon has taught us that. Amazon has taught not us, the whole world, how to reinvest into the business and how to grow business. So the CEOs or the founders that are running those companies, they know more than us. They know better than us on how to run those companies. And if we believe in their vision, then we're going to buy, right? So if you believe in that vision, are they good capital allocator, right? So they can make a lot of money if they stop growing. So if they're optimized for the growth, which means they're hiring lots of salespeople, they're spending a lot of money in marketing, they are doing a lot of R&D to come up with the next set of product, then sure, it's not going to have a profit. So what I'm going to look for is the business growth. I'm going to not judge them on the basis of the profitability only, or GAAP profitability for that matter. I'm going to look at free cash flow profitability. I'm going to look at operating cash flow profitability. I'm going to look at their growth rates, that if they're spending a lot of money in their businesses back, or they're investing a lot of money in their businesses back, are they giving me good payout ratio, as an investor, right? If they're giving me good payout ratio in terms of the revenue growth, and the total addressable market is huge, why not? I will stay there. I will stay with that company. So yeah, painting the companies with one set of parameter or one set of criterion can be very, very dangerous, right? Look at what stage of the company that is. If the company is optimized for growth, it's not going to have profitability. And your stage 1 and stage 2 and stage 3 companies are not going to be optimized for profitability. It's going to be stage 4 and stage 5 companies. And am I in stage 4 companies? Yes, I am. But then I'm checking their profitability, right? I'm checking the profitability for Apple. I'm checking the profitability for Microsoft, for that matter. But I'm not checking so much the profitability for Amazon. because I think there's a lot of room for them to grow, right? In the same way, if I'm in a young company, I'm not going to check the profitability too much, or I'm going to check it, of course, but it will be down there as number 4 or number 5, not number 1. Because if I apply that screening criteria as number 1, then I'm going to screen out those companies and I will be never able to buy those great businesses, which is going to give me exponential gains of power law returns, right? So yeah, having said that, I think I'm going to stop here. I know I had a lot of things to say, but I think probably we'll cover those things in some other time, and we're going to stop. And Fahad, if you have any question, or if we have any questions from the guys that are joining in, please feel free. Let's take some questions before we.
Sure. So before we do that, Brother Afzal, I just want to thank you so much for being brief. I know what you've given or talked. It just sounds a lot, but actually it's not a lot. So I still call it a brief introduction. So thank you so much for putting time and effort and sharing everything with us. So having said that, I mean, guys, if you have any questions, just feel free to type it in the chat. I've still muted all of you, and we'll just spend like 10 minutes or so, and then we can call it and we can have a follow-up meeting. I envision having a series, so consider this just like a basic introduction, and then our conversation will develop, and we'll inshallah touch on more points. But if you have any questions, I've already given a few questions to Brother Afzal, which was sent by people in the last few days. So, brother, if you want to take a couple questions from there, and then
Yeah,
we'll wait.
you wanna ask me, or I want to read myself and just take it? Just
You know what? Let me ask you instead of you doing reading and everything. So I think this goes back from yesterday. One of the brothers, he sent me a message asking about the profitability, and also he wanted to get a breakdown like within his portfolio, amount or the percentage of stocks that you should hold from an investor perspective. And obviously this brother, I'm sure he's doing trading and swing and everything, but I think his question was just talk a little bit about the percentage. I know you've already told it, but we just want to reiterate on that.
sure. So look, guys, as my last name suggests, I'm a business person. I come from a business family, and we are the family of traders, right? And trading is kind of ingrained in me, and I get it, how difficult the investing can be for the people who are business minded and trading minds, having a trading mindset, right? Because I have it. So I hear you guys. I actually applaud that brother, and I know he asked me that question before as well, but I never replied to him publicly for a reason. Because for most investors, my answer to you is stay away from trading. Stay away from trading. Because even if you think that you're a smart trader, I like to think myself I'm a smart trader, but I've given you an example, right? I was a smart trader in 2010 and 2016 and 2014 when I bought and sold Tesla. And I looked, Apple. And I looked really good in those few months as a trader. But as an investor, I'm looking pathetic today, right? I missed out on 100, $6 going to 130. How many X is it, Fred? It's 20X, right? 20, 25X on Apple, right? I missed out on 10X on Facebook, for that matter. I missed out on more than 10X in Tesla by doing those trading. So you may look good for a week or two or months, but those good stocks you should never sell. So here's what I try to do, right? Because I'm a trader myself, and I want to quench that thirst without impacting my long-term portfolio. So you can actually play with 10-20% of the money that you want to put in the stock market. Make it separate. make it in a separate account if you can, and just play around with that 10%, whatever you want, or 20%, not more than 20. Do not touch once you've got a good stock, once it's increasing, you're winning. Let your winner runs, or winners run, because there are a lot of winners, inshallah, and cut your losers every year, right? Every year you get rid of 4 or 5 companies out of 100, or 10 companies out of 100 every year, not more than that. So that's your investing. So yeah, about 10 to 20% do the trading, but try and make it a point that you're going to stop trading soon, that you want to go towards that zero. I would want to go towards that zero. I'm working on that myself. Have I answered that question, Rafal?
That was great. Thank you, brother. So I think there's another question tying down to what you just mentioned. So there's a brother, he's asking, does a stock of a good business reach a saturation point, right? I think it's kind of self-explanatory, but I think it just needs a little bit more clarification on that. And so the main question is, does a good company stock ever reach a saturation point? And when does it become not worth holding, right? Like you said, like sell off your losers, right? What is the mindset for that? What's the thought
So when I
process?
say sell off the losers, if I'm doing the rebalancing of the portfolio every year, then I'm looking at the stock price, for that matter, for that year, right? But sometimes some stock price, like Tesla, they are giving you a big example of Tesla, that if you were holding it from 2014 to 2019, year after year, it would not do anything, and you would have probably sold. But when you look at that, there's a big market. A total addressable market is so big, right? It's every car in the world that can go to electric. And that's not going to happen for next 50 years even, believe me. Even after 50 years, we will have gas-powered car, which means that there was such a huge market. If you have a stock and a company that is in a huge total addressable market, even if that's not working well for you, hold it. Okay, is your thesis, if your business thesis is broken, right? If you think that Zoom was a fad, it was just a good software, a good communication tool during pandemic, then you should sell, if you believe in that, right? At least you sold Zoom on the thesis then, not just based on just the stock price. So yeah, it's very difficult to answer a question without the stock that brother may have in his mind. But yeah, and that's why selling has to be very, very difficult. You have to make the selling difficult for yourself, right? And if you are, brother, in 50, 60, 100 stock, the other day I was telling to one of my friends that I consider my number 2 in my portfolio as good as my number 59 if I have 60 stocks, right? So he was asking me, was pressing me, what about Zoom? How much do you believe in? I said, I believe in that business. I believe that's still going to do well year after year, not just this year. And I want to hold it. But if it doesn't do that, I don't care. I really don't care, because I have others, 100 stocks that can do a job for me. That's why I don't want to be emotionally attached to the company, right? So if you have spread it out in those companies very well, diversified it enough, then you are not consumed. You're not supposed to sell right away. And it's a very difficult question, guys. You can have 8 to 10 guidelines for yourself of when to sell. When your thesis is broken, you sell. Should we sell Amazon? For sure, no. Not at all. Should we sell Tesla today? No. No, think about it. Even if it is $700 today, it might go to $400. And that's volatility, by the way. You will buy more at $400. I can do trading. I did trading in Tesla. But my core Tesla position, I'm not selling. Just think about it. Every single car in the world can become electric car. There's a big change going on in the world. And who is ahead? Tesla is miles ahead than others. Tesla may not even do anything for next 5 years. We make it a period for next 5 years for Tesla that stock has just done nothing. But since it is such a big market, it's such a big market, and we are talking about leader, we're going to stay in Tesla. Right? We're going to stay in Amazon. We're going to stay in Microsoft. If you're in a fad, am I sure about Peloton? I'm in Peloton, by the way. Am I sure about Peloton? Am I going to be in Peloton forever? Probably not. I don't know. Right? Am I watching Peloton business very closely? Yes. Can it become a cult that Apple has become? Yes. Can Peloton become like Apple? Yes. But can Peloton become like Fitbit? Yes. You don't even hear Fitbit. I'm wearing Fitbit, but you don't even hear Fitbit as a stock. Google bought it, right, at a $6, whatever. Right? But if it is one of the 100 stocks that you own, your losses are not that great. In fact, your losers after a certain point in time will not even matter to you, because you have big gainers, the big winners, and that will make major part of the portfolio, and then the loser becomes so small that it's 0.5% or 0.75% of your portfolio. If you sell it and buy it in another one, that's fine. It's not such a big decision, guys. It will not become such a big decision if you're given enough time to your portfolio to grow. It is big if you're starting out now, right? Hopefully I've answered that question.
Thank you, brother. Thank you very much. That was good. We'll probably take one or two more questions, brothers. So one question that I am reading in our chat group right now is from Brother Maz, and he wanted to talk about valuation of rapidly growing stocks. But I think, brother, Afzal, that's a little bit lengthy topic. Unless you have like a 1 minute, answer for that. He just wants to know what would be a good way of evaluating rapidly growth stocks. Like DCF works well for companies with predictable revenue or FCF growth, but DCF seems to fall apart. It just feels a little bit. So I'm going to go to another question by a brother. He is asking, I think this is more like what would you do, your opinion or your 2 cents. Can investing become like a full-time job? Basically, this brother wants to know how can I convert whatever he's doing right now and going into investing as a full-time job. What would be your suggestion?
Sure. I'll actually try and answer Maz's question, because I think I can do it in 30 seconds.
Okay,
Maz,
perfect.
great question. The valuation is such a topic that nobody agrees with, actually. There are a lot of valuation models, the DCF model that you rightly said, the discounted cash flow. And one of the input into the discounted cash flow model is a growth rate assumption, right? And if you have your growth rate assumption wrong, you're going to value this business very differently than what market might be. So for valuation, it's a very emotional topic for people, including me at times. What is the right value and what is the wrong value? What I would say is that if there's a business which is expanding crazy, all of your valuation model will be out of window. It will not work. And if you are, I'm going to just share my screen with you for a second, in a very quick second, and I'm going to send this paper to you, Maz. This is from Michael Mauboussin. Is a great fellow, by the way. Is a great researcher. And can you see my screen right now?
Yes.
Okay,
yes.
So you look at that. When your growth rate goes about 20%, your multiples go exponentially high. It's a concave shape distribution there, right? Which means that you have to, if your growth rate is high, you're going to pay a large multiple for that business, right? So yes, for growth companies, valuation is very, very difficult. Sometimes I do not look at valuation too much. Okay, I look at some other things that can help me, invest in those businesses, because I looked at it and then never bought some of those stocks because it looked really, really expensive on the traditional valuation matrices. So the second question, brother asked if I want to do it full time. Look, this is more of a personal question rather than it depends on your portfolio. I'm not sure if you're asking me that you want to manage your own portfolio and retire, right? That you will have enough money coming out from that portfolio that you don't need to work elsewhere, and you can just try and manage your portfolio as full time, and then take the money out. So that's pretty much a retirement question, and that depends on your nest egg and how much money you have asset under management under yourself, right? And if you want to be in a money manager as a profession that people should come and invest with you, I think what you need to probably first build, in my opinion, is a track record, right? Why would people trust you and invest with you, right? If the track record helps, your investing philosophy helps, your investing strategy helps. If you have a good, sound investing strategies, and if you have a group of friends or families or even strangers who believe in you and who can put a trust in you, you can become an investor, full-time investor, right? But I think probably you might want to build your kind of track record a little bit for a year or two at least, if not more, and then have your strategy and then see people invest with you, right? But you do it for yourself first. I think that would be my kind of not advice, because I'm not in a position to give you advice, my opinion rather.
Thank you very much. I think the last question, Brother Afzal, before we wrap it up, is a brother asks, would any recommendations on reading up on books, authors? You've mentioned a couple authors that you follow personally. You're online. I know you're on Twitter. You post links from other individuals and everything. Any suggestions, recommendations from that point?
I think if you want to read few books, I would start with the kind of beginner's book as well. There are 3 books that I can recommend at this point, because I've read 2 and then I want to read the third one. I read the third one long back, so I want to reread it. Peter Lynch, One Up on Wall Street, by Peter Lynch, I want to read it. It has been a while I read that. The other book that I'm currently reading is The Psychology of Money by Morgan Housel. It's a fantastic book about psychology, because we have not touched base with psychology at all in our lecture, in our talk today. But psychology plays, if not more than the equal role as selecting business and buying the stocks, because the psychology will keep you invested in the market. So I would highly recommend. I'm probably more than halfway through the book right now. That's my Christmas time reading. And Psychology of Money. Third book that you might want to read is by the 2 brothers, Tom Gardner and David Gardner. They're just people like you and me. They were, but of course they made themselves into the investing world. Multi-Fool Investing Guide, I think, is the name of the book that I really liked. You may want to consider those 3 books as kind of beginners. And then there are so many advanced books that Brother Hossein keeps suggesting. If you want to go into advanced, and I would want to go there. There's one other non-investing book that I want to suggest is by Malcolm Gladwell, Outlier. If you want to read about life in general, and there's a 5th book that somebody suggested to me, which I'm yet to read, is David Epstein's book. I think it's The Range. That's on my reading list, by the way. But you want to start with Peter Lynch, One Up. You may want to look at Psychology of Money, Multi-Fool Investing Guide. These are kind of some nice beginner's book without so much jargon from the industry.
That sounds great. Thank you so much, Brother Afzal. I think before we close out, again, I just want to thank all the brothers who've given us this time, and especially Brother Afzal. Impressive, incredible, and impeccable. These are the 3 things that I just thought about it. The idea is we will continue this conversation. And, guys, if you have more questions on topics that you want to hear, listen, we can do once a month, workshop type of deal. and then we'll we'll also touch base on a little bit on trading as the time comes. But I think this was great. So thank you so much, Brother Afzal, and thank you so much, everyone.
No, thank you very much for having me, guys. And I will actually post the name of the books in our WhatsApp group. All 3 or 4 books, inshallah.
Okay, inshallah, brother. Thank you, Jazakallah, and Assalamu alaikum, and Happy New Year's.
Thank you very much, and yes, Happy New Year. What a year it has been so far.
Oh, yeah, definitely.
Okay, Happy New Year, inshallah.